Greece has threatened to default on its bondholders who do not take part in the €206 billion debt restructuring that the country has proposed. Markets are eyeing the Thursday deadline when bondholders agree to the haircut, which will be around 70% of their holdings. The deal will clear the way for Athens to receive the bailout money and avoid a catastrophic default on the 20th of March. All right, and for more on the story, we've got Tom Bosa, who's the head of market economics at the National Australia Bank Group, who joins us on the show from London. Tom, clearly a big day for Greece tomorrow. Bondholders have to give their nod for the bond swap deal, but analysts believe that private sector participation is unlikely to be high enough to avoid credit default swaps. Do you think that is the case?
Well, to quote Alex Ferguson, it's definitely squeaky bum time in terms of bondholders. I think they just might be able to get away with it. Remember, the Greek government has said we want a sign-up rate of at least 75%. Otherwise, we're going to trigger the collective action clause. In other words, we're going to say to all the bondholders, doesn't matter if you're a holdout, we're going to treat you the same way as if you weren't. So far this morning, we've basically got the Greek banks, we've got some pension funds controlled by the Greek government, all signing up to the PSI. There's about 60 billion euros there. We've identified another 50 billion euros from European banks, so we're over halfway. We're about 52, 53% acceptances. We've got to get, another 22%. I'm sure European governments at the moment will be putting heavy moral suasion on their banks to join the PSI, so we might get 75%. We're not going to get the 95% that I think that had originally been hoped for. So yes, I think we'll get over 75%, but collective action clauses may still be triggered.
Now, Tom, Greece has also threatened to default on any of its bondholders who do not take part in the debt restructuring and force them to accept the deal. Isn't this an area of concern? Because this will most certainly trigger credit default swaps, leading to more uncertainty in the financial markets.
Yes, I mean, generally, the whole idea of a collective action clause where you force creditors to accept terms that they haven't voluntarily accepted is a credit event. And that should trigger CDS, and that, after all, was what CDS was supposedly written for. But in the case of Greece, there's only about 3 billion outstanding at the moment. A far cry. I mean, it's 10% less than it was a few months ago. And certainly we've seen CDS, as it's matured, be wiped out, and no one's been writing anymore because a Greek default was seen as inevitable. So I think with only 3 billion out there, this is not a large amount of exposure. Yes, some insurers will pay up. But I don't think that's necessarily going to be a huge economic event, and certainly it won't add too much contagion into the Eurozone economy. I think we've managed to ring-fence Greece. Remember, 3 billion in CDS versus 1 trillion euros in liquidity from the European Central Bank.
But, Tom, the consensus seems to be that this bond swap is not really going to help Athens in the long run. Also, we are reading reports that some private sector creditors are unsure about whether they should participate in the deal. So is the threat of contagion in the Eurozone still alive?
I think there's still a threat of contagion in Greece. Remember, if we get this PSI through, we're still looking at a debt-to-GDP ratio of about 120% of GDP by 2020. Under the Eurozone's own rules, that should be closer to 60. And therefore, it's fair to say that if this credit restructuring goes through, we still believe that Greece will have to see another wave of debt forgiveness to get the debt-to-GDP ratio down to some reasonable figures. For private sector, what's in it for them for accepting this? Well, of course, the only sweetener they've got in there is about 30 billion euros worth of bonds, which are written by the EFSF. A full Greek default gives them nothing. At least this way they get to keep 30 billion out of 206 billion euros worth of bonds that they had in the first place. And I think that's the only sweetener. Greece will ultimately default. How much can the private sector get kept back? I actually don't think the risk of contagion into the periphery is that strong. Wouldn't be surprised if CAC is triggered tomorrow, if we do see a further ratcheting up of Portuguese and maybe Irish bond spreads for a while. But we do think that Greece is unique. It's where the debt-to-GDP ratio is the worst.
Now, Tom, the European Central Bank has big stakes here. The IMF warning yesterday puts the central bank in a very precarious position. They have an exposure of over 177 billion euros to Greece. Do you expect Mario Draghi to comment on this deal tomorrow, or even take policy steps to further boost liquidity and somewhere, maybe diffuse the crisis at hand?
I think Mario Draghi will be speaking tomorrow. I think he'll 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 be speaking tomorrow. I I think the ECB have done a lot. Have they done enough? It's too early to tell. Clearly, with European governments being forced to push through austerity measures, and we're seeing tightening everywhere next year with the possible exception of Germany, we need monetary policy to do all of the heavy lifting. Now, of course, the ECB has added 1 trillion in liquidity over, in the past 3 months. That's a step in the right direction. But when we compare it to the Bank of England and the Federal Reserve Bank, which have sort of trebled their balance sheets during the financial crisis, the ECB has only gone up by about 2.5 times, so it could still do a little bit more and still be in line with its international peers. And I do think, should we require more liquidity, ultimately the ECB will be providing it. It is a form ultimately of quantitative easing, but it's a way of getting around the tensions within the euro system of banks.
And finally, Tom, what of the unknown? Are markets factoring in surprises from the peripheral economies? Because the game is far from over, clearly.
Perhaps one surprise might be that growth in the core, again, is stronger than expected. The markets have been fairly bad at forecasting German GDP growth recently, generally getting it wrong by a factor of 3 or 2. They've always been overly pessimistic. We actually believe that the German economy will have another good year. Germany actually hasn't been doing very much in the adjustment process. It still has a very big trade surplus, and if anything, it's been forcing France to reduce its trade surplus and therefore do some of the adjustment within Europe, which means that Germany could grow by 2%, which again puts Europe on track for perhaps positive growth rather than the negative that everybody's looking for. But certainly in the periphery, falls in GDP of the magnitude of 2, 3 or 4% look likely, whilst Greek and Irish governments this year do an awful lot of fiscal consolidation.